In this video, guys, we're going to look at how to make money from a falling market. Stay tuned. Hey traders, a warm welcome to Alright, so how do you make money in a falling market? So this could be a broad market, could be an individual stock, could be a commodity, etc. Now, many people will pick out a stock that they feel is vulnerable. So even in a bull market, you have a raging bull market, loads of stocks are lifting up. There will be a handful of stocks that are still getting beaten. They're an industry that's having lots of changes made, lots of shifts, lots of movement from kind of one sector, a technology disruptor, all this kind of stuff. They've got a lot of problems, a lot of overheads, whatever it may be. Don't just go into the details of it, but you might want to pick a stock specifically, or again, a broad market you think is going to go low. So how do you do it? So if you're looking at an individual stock, you can short sell a stock. So you can go to your broker, and most of this is done automatically, but you can sell a stock short. In other words, you sell it before you own it, then you buy the stock back lower. So you're literally traditionally short selling a stock. So you're borrowing the shares from somebody, you pay a fee to borrow it. I've done a whole video on this, by the way, so it's a brief overview, guys. You borrow the stock, you say thanks very much, you pay a borrowing charge, financing charge, a borrowing cost on that stock, sell it into the market, you get the money back, but of course you still owe that person the shares. Market falls lower, you use some of the money to buy back those shares, you give the shares back, you pay your borrowing costs, and you keep the profit. That's really the main way that people will short sell it. When I say it's the main way, it's kind of the official way. If you like, there is an official way. It's a traditional way. It's probably the better terminology to take advantage of a falling stock price is to short sell the stock. Right. The other thing you can do is you can buy a put option. So a put option gives you the obligation, but not the obligation to sell a stock at a specific point in time, a specific price in the future. So if you buy a $40 put option for June expiry, it means that you can sell that company at $40 in June, whatever date in June that is. So if it's suddenly trading at $10, you are going to sell it at $40 because you're going to buy it back at $10. So you've made $30 profit on that stock. So a put option is a great way of taking advantage of the downside, but you've got to be right in terms of the time frame that you're picking, and of course the strike price. I've done a series on options, so if you want to kind of check out more on that, go and have a look in the video section, have a search for options. Got lots of things, we're going into different details and strategies, etc. But broadly speaking, it's a good way of getting exposure. Reasonably good from a perspective that you get a lot of leverage with options, and if you're buying an option, we'll look at selling one in a moment. If you're buying an option, you can't lose more than the price of the option. The worst that it can go is to expire worthless at zero. So if you pay $5 for it, it goes to zero, that's it. It can't go any lower than that. So that's one advantage of that. Forgot to say, actually, the disadvantage of short selling a stock is you're paying interest and financing charges every night that you've got that stock on loan. All right, so another one is to short an ETF. So an ETF would be a broad kind of multiple stocks or instruments in a market that's wrapped up and offered as an exchange traded fund. So you might have a sector like the financials, you might have a sector like the transport sector, or some kind of country like Brazil or emerging markets, or there are hundreds and hundreds of ETFs, commodities even, you name it, you've got an ETF. And by the way, I've done some videos on ETFs as well because they're a completely separate topic. But that's a way of getting exposure to a specific sector or specific segment of the market that you really believe has got some downside to go. So rather than a broad market exposure, which ETFs do as well, you've got the S&P 500, which is the SPY ETF, or you can go granular as you want and just have a handful of stocks with an ETF and pick those and think that sector is going to underperform and short that. So you can short that just like you were shorting a stock, because an ETF trades pretty much like a stock, or you can even buy a put option on an ETF. So you can trade options on an ETF as well. All right, another one you can do, if you can't short, you can't do options, you can buy an inverse ETF. So there are ETFs out there that are inversely, have an inverse relationship to the market they're following or tracking. So, for example, if the market they're tracking goes up by 1%, then they would go down by 1%. But the advantage, if that market goes down by 1%, your ETF goes up 1%. So you're basically gaining from a fall in the underlying asset that it's tracking. So if it's tracking S&P 500, if it's tracking FTSE, if it's tracking NASDAQ, if it's tracking the financials or whatever basket of stocks constituents are in that, then as they go up, this ETF will go down. But if they go down, you're correct in your short thesis, that ETF will lift in price. And you've got stuff like double leverage, triple leverage. So for every kind of 1% that those basket of stocks go down, then you might, if you have a triple leverage, your ETF will go up by 3%. So you can take advantage of opportunities in that way. Number 5 is to sell a spread bet. So very, very similar to going short a stock, but without the hassle of having to borrow this and the other. Yes, you've got charges if you're selling, if you're going short, to borrowing costs potentially, but it's very, very simple. You're betting on a downward fall in price. It's in pounds per point. If you do £10 per point on the FTSE, you think the FTSE is going to fall, and yes, it does. It falls 100 points. You make 100 times 10, you make £1,000 on that trade. Very simple, very easy to calculate. Again, you can trade on leverage, you can trade on margin, etc., etc., etc. Channel sponsor we've got in the description below. Check it out if spread betting is your thing. Number 6, shorting a CFD. Very similar to a spread bet, except it's a contract for difference. So this would be like a stock, but it's wrapped up as a contract. There are some pros and cons to that. I've done a couple of videos, we're going into depth on that. But again, similar type of thing. Spread bet, CFD stock, it's exposure to a specific instrument. You know, you're picking a specific stock like Facebook, like Amazon, like Tesco, like Vodafone, etc. Or you could, again, if you want to go another level down, you could do an ETF, and that would be traded like it was almost like a stock. And you could probably spread bet. A lot of spread betting providers allow you to, in fact, they definitely do allow you to spread bet on ETF. Same with CFDs on ETF. So you can either go direct to the exchange and use a stock, or you can use a spread bet, which is a tax-free wrapper if you're in the UK, or you can use a contract for difference. Number 7 is the other option one. Rather than buying a put option, you could sell a call option. So you could sell a call option to somebody. A call option gives somebody the right but not the obligation to buy a specific share at a specific price at a specific point in time in future. So let's say we had company ABC, and let's say it was a $20 call option, and it was a June expiry again. Let's say it was June the 18th, whatever that is. If the price, and it was a call option, if you're a buyer of that and the price of ABC is at $50, then you can use that to buy at 20 and sell it at 50. So that's a good way of doing it. However, if you are a seller of the call option, you're effectively bearish. So in that instance, then when the contract expires, then you would be in loss. However, if the price goes down and your short thesis is correct, let's say the price goes down from $20 to $10, that call option will expire worthless, and you'll have made the difference in the price of the option that someone has paid at the time. So the premium will be all yours. So it's a way of capturing without buying a put option. And really, again, I've kind of done option series here, but this is a way of taking advantage of a volatile market as well. So volatility is high and people are expecting things to be high. You're selling a call option and you're capturing that volatility because you're capturing that whole premium as well as a directional play potentially on the market falling. Danger of a call option, selling a call option, is you've got theoretically unlimited risk and only capped profit potential. So unlimited loss and capped profit potential. So make sure you understand the instrument you're trading before you kind of get into options. But it's a broad overview, guys. Those are the seven ways that you can make money from a falling market. Most of us are probably going to go into this one, selling a spread bet, perhaps selling a stock, maybe selling a CFD, and perhaps going into the foraying into the ETFs if you want a little segment of the market we think is going to underperform. All right, guys, take care. See you in the next one. Bye-bye.